First, revenue recognition principle. Second, matching consent principle. Third, historical cost principle. Fourth, full disclosure principle. And fifth, objectivity principle. So right now I'm going to talk about revenue recognition principle. Revenue recognition principle states that revenue should be recorded and recognized when it is realizable and when it is earned. In other words, companies shouldn't wait till the time the revenue is actually collected to record in the books of accounts. So revenue should be recorded when it has been earned. Revenue recognition principle is actually one of the most important concepts in the accrual basis of accounting, because revenue is recorded even though the money or the amount has not been received yet. In addition to that, the revenue recognition principle should be fully or partially completed, and there should be a certainty that the amount would be received. For example, Johnson Waldorf is an accountancy consultancy firm, and they have entered into a contract with one of its clients in the month of December. But the client paid them in the month of January. But in this case, Johnson and Waldorf Company would record the transaction in the month of December because the revenue has been recognized in the month of December.
Hi friends, I'm Tanuja. I'm here to discuss about the historical cost principle, an asset which is normally recorded in the accounting records at a price paid to acquire an asset at the time of its acquisition, and the cost becomes the basic for the asset to acquire an asset at the time of its accounting records and subsequent accounting principles. Although if nothing is paid to acquire an asset, it is usually not recorded as an asset. For example, in the booming real estate market, the fair market value of the land 5 years later might be $35,000. Although the market value of the land significantly increased, the amount entered in the balance sheet and other accounting records continue to remain unchanged at the cost of $25,000.
Hey guys, I'm Jessie and I'm going to speak about the matching principle. Matching principle states that all expenses must be matched in the same accounting period as the revenues they help to earn. And matching principle is one of the most fundamental concepts in accrual accounting. In simple terms, the matching principle means that in a given period of time, the expenses that are recorded in the financial statement of a company must be related to the revenues generated in the exact same period. Let's have a look at an example. Consider a company, and the company buys a machine for 10 lakhs in 2018, and the machine has a useful life for 5 years, which means that the machine will produce products for at least 5 years into the future. Now, according to the matching principle, the machine's cost must be matched to the revenues it creates. Thus, the machine is depreciated over its 5-year useful life instead of being expensed fully in 2018.
Hello friends, myself Anirban. I'll talk about full disclosure principle. Full disclosure principle requires the organization to publish all the necessary details either on the face of financial statements or as notes to financial statements. This information is very much required by the managers to take decisions based on the information present on the financial statements. Footnotes are often used at the end of financial statements, which gives a brief about how property is depreciated, or how revenues are recognized, or how income taxes are accounted for. Details of contingent assets, contingent liabilities, quarterly earnings, press releases, or if the company has sold one of its subsidiaries to any of the spouse of its directors, that is also disclosed in the financial statements.
Hi my dear friends, I am Shobit. Today I am going to talk about Objectivity Principle. Objectivity Principle is a concept that financial statement of an organization should be based on solid evidence, such as it should be definite, verifiable, and free from personal bias of an accountant. It means the information must be based on research and facts. And also, financial statements and audits should be done objectively, since the investors and creditors are reliable on these records, and it should be independent. Hope you understand what is objectivity principle is, and thank you for watching our video.